I don't think it's a black and white thing. You really have to have the net worth for it to make sense. Most investors out there have retirement funds like a 401k or a mutual fund. They have their home, they have their car, they have their investment portfolio. But if a person has a lot of capital, they might want to consider other things to invest in and other products to invest in.
Everybody, welcome back to Break Free from Wall Street, the show where we explore how investors can move beyond stocks, mutual funds, the public markets, these conventional assets, and understand how real capital is being deployed in the private markets. Today, I have the pleasure of being joined by Oliver Mitchell. He is a partner of FF Venture Capital. Oliver is leading the investments in robotics, AI, drones, industrial automation, climate tech, really just all of the technology of my childhood dreams, to be honest, while also building a strategic alliance with limited partners and corporate venture groups. Really impressive, really fascinating stuff. Oliver, welcome to the show. Thanks so much for your time.
Thank you, Nick. This is really a great opportunity. I appreciate you taking the time, and I look forward to our discussion today.
Yeah, absolutely. Yeah, joining us from the Big Apple today from New York. Really grateful to have you here. Tell us, I talked a little bit about your background. Tell us maybe anything that I may have missed, anything that you're working on, and some of your background as well.
Absolutely. I think you did a great job on the intro, but just to fill in some gaps there, I got into this because I'm a longtime founder and operator of startups, and I built companies and then sold them to big multinational organizations like a financial services company that I sold to American Express, and then I got involved in a turnaround of homeless protection and sold that to ADT Tyco, which later became part of Johnson Controls. And after my last startup, which was in the STEM robotics space, I started to take a deep dive into the industrial automation space. I did that of one of two ways. The first way is I organized my own investment vehicle called Autonomy Ventures, and I made a bunch of investments, either as an angel or I organized my own special purpose vehicles and brought in my own investors and had a bunch of exits, three really meaningful. Novacure, which is an Israeli medical device company that today trades about 3 billion market cap. Another one is Exobionics, who's the first exoskeleton, comes out of Dr. Kaz Marooni's lab out of UC Berkeley. And today that also trades on the NASDAQ. And my biggest meaningful exit was in an AI ad tech company called Triple Lift that got bought by Vista Private Equity for 1.4 billion. And the second way that I engage with the autonomy community is I write articles about robotics and drones and AI, just the types of technologies you spoke about before. Very funny. Was always known as the robot guy in New York because I had a business called Robot Galaxy. And my marketing department, when the blogosphere was getting launched, they're like, we're going to launch a blog for you and we're going to call it Robot Rabbi. They know I'm Jewish. And I was like, wow, okay, well, I guess I got a promotion. So what am I going to do with that? And so I started to write articles and interview people within the automation space. And all that today is capsulated in a book, a little shameless plug here,
There you go.
called A Startup Field Guide in the Age of Robots and AI, where I interviewed like 30 luminaries within the industry, people like Rodney Brooks and Helen Grenier, who founded iRobot and built it up into the number one selling automated appliance out there. People like Mick Mounts, who founded Kiva Systems and sold that to Amazon for $775 million, or Ryan Garby, who sold ClearPath Robotics to Rockwell Automation, Nick Radford, who ran the robot lab for NASA and built Robonaut, launched Robonaut 2 to the ISS and Valkyrie, and now has a humanoid robotic startup where I'm an advisor called Persona AI, and we're going to be doing shipbuilding with humanoids for Honda IHD and many others. And so it really takes you on the journey from having an idea from napkin drawing all the way to IPO. And so that's the other way I engage in the community. After my own run, in my own investment vehicle, I ended up joining some friends at FF Venture Capital and really opened up deep tech. We're investors in a supply chain logistics company called Plus One Robotics, and a robotic agriculture company called Burrow, Civ Robotics and construction tech, Cayman Robotics and smart manufacturing, and many others. And so that's my traditional role. I also have a fund out of Israel called Arkenstone Capital, where I'm
Mm,
a partner. And some of the best deals, both private and public, have been Israeli startups. And they come out of the most elite units, and that's where I'm investing. Like companies like Wiz that got by Google for $32 billion, or CyberArk that got by Palo Alto Networks for 25 billion, or Checkpoint, which it's one of the highest producing NASDAQ companies, or JFrog. And so they come out of the Unit 8200. They come out of the Shabak, which is like Israel's FBI, the Mossad, like Israel's CIA. And so right now I'm sourcing deals out of Israel and then scaling them up here. And so that's how I spend my day. I also teach at a university here in New York, a course called Entrepreneurship and the Management of Change. And I look forward to having the discussion once again.
yeah, thank you for I mean, that's really I mean, the future is here. Everything that you're talking about, I mean, with robotics and AI, and I mean, just really the everything in the tech sector right now is really exciting for me as somebody who loves, new and emerging technologies, especially with everything that's going on with AI and robotics. I know it's scary for a lot of people, and it is going to be something that really I think shapes society in a completely different way. But for me, I think that's there are some really exciting things about that. And you're really right there on the. It sounds like that you're really there on the forefront of all of that that emerging technology.
Yes, automation is going to shape everything, every industry. And I think it's important for your listeners to differentiate between stuff that's being promoted for the home and stuff that's within enterprise and industry. I think the home is gonna be a lot longer. I mean, I'm still waiting for my robo taxi to pick me up from my apartment and take me to Midtown Manhattan. I mean,
Yeah.
we have Waymo in Los Angeles, in San Francisco, in Arizona. They tend to get a lot more sun than New York and
Mhm.
Boston. A lot easier. There's other companies besides Waymo. There's Zoox. Obviously Tesla's gonna be it has their own robo taxis, robo cabs, as they're calling it in Texas. But I think, when looking at consumer and looking at robotics in the home, it's a lot more challenging. And you really have to, you know, think about these technologies of really the three rules. One is it has to have high utility. You can't have a robot that's used once a day to pick up 2,500 pounds, and 23 hours in the day, it's collecting dust. That just does not make economic sense. It needs to have high reliability. I mean, shit can't fail in industry. It's gonna
Mhm.
hurt somebody. And so it has to, be up all the time, because people do not have patience like they do have patience for software. We're used to a blue screen. We're used to rebooting our computers. Rebooting a robot can lead to catastrophic damage, and it needs to have payback. You can't have something that's enormously expensive out there that, that costs more than human workers, that is, slower, that is less effective. So if we look at Civ Robotics, for example, they are solving a real pain point of hiring surveyors, the first people on a plot of land for industrial solar farms. And so there's a backlog of surveyors because people are retiring. The average age is like 57 for a surveyor in the United States. And
Mm.
after COVID, they retired in droves. And so there's like months backlog. And if you're a developer, you're paying money and not making money, and you can't build. And so their product is 10 times faster. They can do tens of thousands of points in weeks, and hundreds of thousands in months, which would take teams of surveyors to do. And now you just got one guy and one robot doing it, and they're half the price. and they're more accurate because human beings make more mistakes, and so they're killing it out there. And so they're solving a real pain point in industry. And so it's really important for your listeners to understand and ask yourself, what is that pain point? Have these companies done enough customer discovery out there to have a mission critical value proposition that people are going to pay money for? Or is it just really, cool technology that's, ahead of the parade? And if you're too far ahead of the parade, you're not in the parade. And so you really got to differentiate that. So while I am bullish on humanoids for industry, people like Persona AI, that is solving a real pain point for shipbuilding. If you look at the United States, I'm here in Manhattan, as you mentioned. Across the river from me is Brooklyn. In the Brooklyn Navy Yards, we used to manufacture a ship a week. Let that sink in. A ship a week during World War II. Last year, you know how many ships we built in this country?
More than one, I'm guessing.
More than one, but not that many more. Three. China
Really?
built 300. China built 300. That's why the president got up last year in the State of the Union. We have to build ships here. And the problem is that it's not a space problem. It's not a demand problem. It's a labor problem. We don't have the workforce that we did in the 1940s and 50s to do that, because people would rather sell belts on Etsy than weld ship hulls in a shipyard all day. And so you know, Persona is going into heavy industry with high skilled labor, and their first thing is working in a shipyard in welding. And they're working with Hyundai HD, our allies in South Korea, for shipbuilding. And Hyundai can't employ enough people. They go to Vietnam and Thailand to employ farmers and train them in welding, and once they've got that down, they end up leaving, going back to Thailand and Vietnam because they're farmers. They're not welders. And so, we're only gonna be competitive in the Western world by adopting these technologies. So I'd say, I wouldn't fall into sort of Black Mirror dystopian thoughts, and I wouldn't be a Luddite here. I would embrace these technologies and look at the opportunities out there that are being underserved and being underemployed. In robotics, it's dull, dirty, and dangerous. And there are jobs out there today that are just too dangerous, too physically taxing that human beings do, that long-term robots can do, whether that's mining, whether that's, working in a shipyard, whether that's, roughnecking, many others that people can only do for so many years before their back gives out, before they have to retire.
Yeah, and I like what you said where there is a distinction between, a company or some type of technology, trying to solve and search for a problem as opposed to solving a real world problem, these efficiencies that you're talking about. And so when we're talking about, a lot of our investors who watch this show, we're all typically born and raised on the Wall Street playbook, stocks, bonds, mutual funds, these conventional assets. What I mean, you're talking about all of these, incredible technologies and companies that are really going to shape the world, the economy, in a major way. We've kind of heard about your path and how you've built and invested in companies that are living outside of that system, and where that path started for you. Um, at what point I guess, did that switch kind of go off where you said where you kinda realized what real value was actually being created outside of those public markets?
Yeah, I don't think it's an either or equation, if I may. I wouldn't lay it out how you do. That I mean, all the companies that traded and that trade, in Nasdaq, on the New York Stock Exchange, and global exchanges out there started as startups. You know, Sears and Roebuck, it started as a catalog. Ivory started as a soap seller, and they started, peddling, and they eventually built up, into Procter and Gamble. And so that they didn't start, and list their company day one. And so, I'm an early stage investor. So I'm starting with founders, first and foremost. It's very much so a psychological investment that I evaluate my deals in this order: people, product, and plan. It's really that simple. And that if I don't believe in the people, I'm not gonna listen to the product, and I'm not gonna they're not gonna execute the plan. And so I really, you really have to have faith in that these are the right people to build the product that they're saying that could be differentiated in a landscape that could have real IP and have a deep moat to protect themselves from upstarts and competitors, and have a plan to go to market and become a billion-dollar business capable of going public on the exchanges. And so within venture capital, you know, we invest very early, and there's a J curve, that we are fiduciaries, wealth managers, if you would, for high net worth individuals, for family offices, for institutions, pension funds, and so we are stewards of their capital. And it's a long-term proposition. You can't, if you invest in a venture capital fund, you can't, you know, ask, for redemption 2 years later to get your money out. You're only gonna get your money out when there's a liquidity event. And liquidity events, happen in different shapes and forms. One of the great ways of liquidity events is they go public and they're traded on the exchanges, and you could sell your public shares. Up until then, they're illiquid. You can't sell, the private shares, although you can. You could sell them on the secondary market. Once they're worth a certain amount, you could sell them on the secondary market. People will buy your shares, typically at a discount, and that's another way you can get liquidity. You can turn that paper into cash. Or there might be M&A, a big corporate, one of those publicly traded companies like Microsoft or an Amazon might buy your company. And that's another way where our LPs, our limited partners, will get distributions. Or private equity might be doing a roll-up, and they, will look to acquire our companies. Or a growth equity, well, once again, we're investing very early, a growth equity fund that writes much bigger checks, that wants more of a control position, will invest in both primary, will invest in that round, but will buy and ask us to tender our shares, and that's another way we can get liquidity back to our investors. So that is a, 7, 8, 10, 12-year plus, run before our LPs can get back their money. On the public exchanges, out there, if you buy GM, you could sell GM that same day.
Mhm.
It's currency. If you buy Bitcoin, you could sell Bitcoin, a few minutes later. So you can't do that by being an LP, in a fund. So that's first and foremost. Um, you know, I would say that, when looking at these businesses, and looking at a company, is this going to be a billion-dollar business? The first thing I do is saying, like, are they, solving something that's really mission critical out there? And is the technology that they're applying the best tool in the toolbox? And so like Mick Mounts, who I spoke about earlier, who sold, Kiva to Amazon, he was actually at a publicly traded company during the dot-com era called Webvan. And Webvan was predecessor to Instacart. They were doing online grocery. And Webvan was one of these fantastic dot-com busts out there. They blew through $800 million.
Wow.
They didn't do enough customer discovery to find out what actually people wanted to order online. This was a novel thing, and they built these beautiful distribution centers that Mick and his partner, Raf, said that they were just taping $20 to every box that went out the door because they were losing so much money. Because nothing Webvan was the first one to open up the carton, and take the items out of the carton and repack them, to pick and pack, to the customer. So if you were gonna order, like, tomato sauce, if you're gonna have pasta tonight, you order tomato sauce and a box of pasta, you had to open up 2 cartons and then repack them. And so
Mhm.
after he left Webvan, he's like, "This idea of e-commerce fulfillment is really a problem that no one is addressing. I think I have a way to address it." He didn't say, "I want to build a robotics company." He said, "I think I have a way to address it, and a mobile robot that brings the shelving to the picker is the best way to address it." And he ended up serving the top 10% of e-commerce companies before Amazon bought them. And actually, they learned about them because they acquired Diapers.com and Zappos that year, and they saw how efficient Kiva was. And the first thing they asked after completing the Kiva acquisition was, fire your customers because we want this to be exclusive to us. They paid $775 million for that business. It paid for itself within 6 months because they shipped $2 billion worth of goods that year.
Mhm. And that's really interesting. I want to go back to something you were talking about with, with public markets versus the private markets, this difference and this really big difference between the liquidity on both sides. It almost feels like in the public markets that may be an advantage. I'm trying to think what advantages do these private markets, these private funds have over the public side, that where the private side you may not have the liquidity, but what is it that the public side may not have?
Sure, sure. That's an excellent question. And typically, the people that invest in venture capital have a more holistic wealth management strategy where they won't be taking dollars from their mutual funds to invest in the VC. They'll have a blended portfolio that will include, public assets, bonds, real estate, maybe some PE, and they'll have an allocation for VC. And so why allocate to VC in general? Because I just told you you know, y- uh, you're gonna be growing old before you're gonna get a distribution, right?
Right.
So, and if you, I mean, the majority of startups fail out there. Just to be, 90% of them fail out there. And so what is it about VC that makes it very attractive? Why is there so much talk about venture capital? And why are we, as a fund manager, why am I a good steward of capital? And so it's the power law. We invest in a portfolio. And so we have 20 companies. If one or, and half that portfolio will typically go out of business. It'll- For a variety of reasons. Um, there might be external wins, they might have gone into business and then ChatGPT comes along and knowledge management, everyone's using ChatGPT. They're irrelevant now. They're they might have launched a natural process language speaker for and then Amazon, and then they sold for $800, a company called Jibo. And then Amazon comes along and says, we're gonna do the same thing and sell for $39.99. So so they got undersold there.
Mhm.
But then so half of the portfolio you write off. Then 25% will be a wash or a little bit better, you know, about 1 to 2. Then the other 25%, another, say, 15% will be like 6x to 10x. That's pretty good. That's pretty good. And then like the last 5 to 10% will be the ones that make up your whole fund. So, for example, Triple Lift, I invested in them 9 years before they sold to Vista for 1.4 billion. That was an over 60 times return on my money. In addition, there's something called qualifying stock business exemption in our tax code, in our federal tax code, which the Trump administration has actually expanded the definition of. And that if I invest in a company that's worth under $50 million, and I think they made it even right, and I invest 5 million, and now they've extended it to 15 million, uh, and up to 5 million. Now they've extended it to up to $15 million, and I hold it longer than 5 years, which typically venture capital does. I pay zero cap gains tax, zero. And then I'm in a state, New York State, that follows the federal law. And so I didn't pay any cap gains tax locally or federally. So my return, that
Mhm.
60 times return, was tax free. Now, you can't get rarely do you get a 60 times return in the public markets. You're investing in mature businesses. You know, the public markets, you're looking for, a value play, and, so venture capital is a lot more aggressive in that regard. So that's the law, that's the power law. In addition, the idea of having a tax-free return for early stage is very attractive to high net worth individuals.
For sure. Yeah, and, the really the tax savings is in and of itself just I mean, a great value for the private side, along with, as you mentioned, it may be a bit more risky, but there is more potential for the upside when you're looking at these private funds.
I would also add, so we've spoken financially, so let me just speak altruistically a
Mhm.
little bit. So I have an Israel funds. So many people that invest in my funds are aligning their personal values with their wealth management goals. I mean, these companies are great companies. They're all going to be having great liquidity events. They're doing breathtaking stuff. Like I'm investing in an agentic AI company that goes into closed and encrypted social media groups, and they discovered a bomb threat against a big federal agency building, and they alerted them. They discovered 3 hacks. They alerted those corporations of the hacks and so forth like that. Stuff that is mind blowing.
Yeah.
But many of my investors, see all this negativity of anti-Semitism and anti-Zionism and anti-Israel out there, and anti-West and anti-democracy, that they want to align their values, with their investment goals. That's number 1. Number 2 is many people that are attracted to investing, in startups are attracted to being around the founder culture. And, they might come from industry, they might be retired, they might become angel investors, they might invest in funds, and they wanna be closer to those founders. They wanna impart their knowledge within their area of expertise to these founders and have an impact on those returns. So these are not things that you can really model, but these are also drivers within shaping the personality of the types of people that get attracted to venture capital.
That's really interesting. So it's really more about attracting the right investor to the fund, is that?
Yeah, I mean, there are many different types of venture capital funds out there, right? So, like, I'm an author of a robotics book, shameless plug. So, people that really are interested in robotics and automation, should talk to me. People really interested in Israel should talk to me. There are people that are really interested in climate change. And SOSV is a great climate fund out there. You know what I'm saying? There are people
Mhm.
that are into the closed loop economy, of recycling. There are funds for that. There are people really interested in investing in women founders, and there are funds for that. There are people interested in investing in minorities. There are funds for that. There are people invested in Ukraine. There are funds for that. There are people, Israel. There are people. There are people, investing in the heartland. There are funds for that. Steve Case, founder of AOL, has Rise of the Rest. That's a fund out there for investing in the heartland. And so there are funds for every type of interest that you have out there, you know? And so Jim Simons of Renaissance Capital, his passion, recently died. He was the partner of my mentor, Howard Morgan, who was the founder of First Round Capital, now the chairman of B Capital. And Jim had a grandson who was autistic, and so he would invest in technologies that would focus on autism.
Mhm.
So there is that altruistic bent that within venture capital. Now, could you build a public portfolio doing that? Maybe. There are ETFs out there. There's a robotics ETF out there and so forth like that. Uh, but maybe not in the groundbreaking way, because if they're public, they've already, like, most likely been a startup 10 plus years. Getting involved on the ground floor could be very exciting for people.
Right, and like you said, not only aligning your interests with, a fund or a cause or a technology, but, moral values or beliefs even. I think that's really cool. So just a kind of a question to build off of that. Uh, really, I think a lot of investors, myself included, typically hear, venture capital and historically think, these are private deals that are reserved for institutions, family offices, these institutions and people with, these conglomerates with big pockets. Who do you see that is actually investing in your fund today? Are you seeing more participation from individuals, individual accredited investors, individuals? What does it look like from what you've seen?
It depends on the size of the fund, you know? There are funds out there, I mean, 70% of the capital raised by LPs for venture capital funds are in a handful of funds like Sequoia, Andreessen Horowitz, General Catalyst, etc. These are the very large funds that are raising billions and billions of dollars. I work in the world of micro VC, that's under $250 million under management. Um, and it depends on the vintage, right? Is this a first time fund? Is this a second, third? So typically, people who are starting out, those could be great opportunities for high net worth individuals who are accredited investors. You don't want to take your life savings and put it into one asset. The SEC protects against that,
Yeah.
and, you really need to think of it as part of a wealth management strategy that you wanna leave your heirs. I think, first-time funds, that could be a great opportunity for high net worth individuals because, there's less institutions going into that because just the economics of the fund, the institutions tend not to like to invest in first time funds. These could be senior managers who have run previous funds, but because now they're together in a new fund, they're considered a first time fund, and institutions typically won't invest in a first time fund. Um, and so that could be a great opportunity for high net worth individuals. Obviously, family offices and multifamily offices. Uh, are the lion's share of LPs, for, micro VC venture capital funds. And so these are high net worth families, that have an advisor or have a manager that has a holistic view of their assets and alternate assets has, a bucket that they deploy from. And so, it depends. Sometimes people are looking for opportunities sort of pre-IPO and they don't want that J curve that I described that typically is early stage. They want to invest in, the round before the IPO, which it may not be the best opportunity. One is there's no QSB, and also as companies are staying private longer before going public, those last couple of rounds before going public, often are valued greater than what the offering price will be, to the public market just because the underwriters wanna have something that is sellable, to their clienteles. So, but it depends on their strategy and so forth like that. Um, Institutions tend to go in later, but it could be, as I mentioned before, for early funds, for smaller funds, those could be great opportunities for high net worth individuals. I would suggest, understanding that market a little bit better. Maybe you've been an angel investor now, it might be a good hedge to have, investments in a fund as well, be in addition to your angel deals, because also what many funds do is you can invest in the fund and then, we might be priced out of later stage, rounds because, let's just say we have $50 million under management. We're doing, say, 15 initial checks and then say 8 follow-on checks. And then now the company, it doesn't make sense for us to invest more. It becomes an orphan within our portfolio. We want to keep the portfolio, looking the same and so forth like that, diverse types of technologies. But, we want to invest in that early stage and that A stage, but now the B round, we might be priced out of. So we might organize an SPV or an LP might wanna do like a co-invest opportunity where they could invest directly in that next round or alongside that fund, so that could be an opportunity.
Right. And with these high net worth individuals who may have an opportunity to get in, do you ever see capital coming from retirement, self-directed retirement funds, or is it mostly personal capital that you're seeing being deployed?
Once again, they should probably speak to their family, wealth manager
For sure.
and their accountant. I don't wanna give any financial advice here. I have seen people, so a venture capital investment, someone might commit $1,000,000, let's just say, for purpose of discussion, but when we close the fund, we might only call 40% of that. So only $400,000 has to be paid, you know, uh, at that period of time, and we call money as we need it, as we make investments. The best sort of funds, have liquidity events along the way where they don't have to call 100% of that money. And so you could take that money that you thought you were gonna use and reallocate it. Um, if you're gonna do it out of like a retirement funds, typically you would have to, um, what I've seen done is you pay that entire $1,000,000 is dedicated towards you pay that all upfront. So
Mhm.
versus, if you don't do that, it's on a capital call basis. But, I've seen both done with high net worths, accredited investors and stuff like that.
Awesome. And for for venture capital as a whole, do you think that there's any lack of education, maybe not a lack of interest, that is keeping investors maybe stuck or feeling more comfortable in the public markets?
I don't think it's a black and white thing.
Sure.
Um, I think one is, um, you really have to have the net worth for it to make sense. So most investors out there have retirement funds like a 401(k) or a mutual fund, and that's great for them, and that they have their home, they have their car, they have their investment portfolio, that's their net worth. Um, but if a person has, a lot of capital, then they might wanna consider, other things to invest in and other products to invest in, and they should really speak to, the wealth manager, their accountant, because all these things are highly risky, and so, it could be, you know, VC is very much so a club atmosphere that having the access on both sides, by the way.
Mhm.
So, like, you're in Utah, like, I only go to Utah to go skiing, you know?
It's
I
a
don't
good
know the
reason to
people
go.
in
Yeah, it's a
Utah,
good reason to come.
right? Or go camping, right? I
Mhm.
I I don't know the community in Utah. There could be people, you know, family offices or high net worth individuals in Utah who could be attracted to this activities that I do. I am not encouraging them. They should make their own investment decisions. But, I just wanna but because I don't have access to those people, they don't know about me. And likewise, I'm gonna go to the people to invest in me and invest in my deals from my own network or, you know, the network that I'm associated with, And so, like, we might hire a placement agent, to raise capital, for our funds, and that person's gonna go through their own network who's invested in other funds and so forth like that. So it could be tough to break into. Now, with that said, there are many different ways for your listeners to familiarize yourself with the startup economy. There are newsletters out there. Strictly VC is a great newsletter that gives you the funding reports. There's Term Sheet out there. You can subscribe to the Robot Rabbi and read my articles, the Robot Report if you're interested in automation. I also write for them. There buy my book. There are many ways to familiarize yourself. There's, lots of books on the subject. Peter Thiel wrote Zero to One. Not my favorite book, but there's ways you could start familiarizing yourself with it. There's lots of articles about it. Obviously, in the broadsheets like the New York Times, Wall Street Journal, it's sometimes can be go to sort of hyperbolic discussions, but I would say, the Wall Street Journal has some very good reporting on VC. Um, and so you can start familiarizing yourself with VC. There are probably angel groups in your area or in your region that you could start participating in. And so you can learn about startups. You can learn about the different um, financing instruments. We don't always invest via equity. We invest sometimes through debt. There's a safe note, which is the YC safe note. You know, there's accelerators. You can maybe go to the accelerator demo days. You can meet other people within the industry and so forth like that by going to the demo days and see the startups and start educating themselves on the industry. So you are being visible out there. And so you can be invited in to these opportunities. So being passive and just listening to this podcast, as great as Nick is, might not be enough. You might have to go out of, the building and go, and really start networking within these industries to really familiarize yourself with the nomenclature, with the entrepreneurs, with the other investors out there, and they might really be interested in what you have to offer because you might come from an industry that they're trying to break into, and you might have a network where you could be immensely helpful to these startups, and that could be a great entry point to really getting involved.
I love that. I love that. Looking more, I kind of want to bring it to more looking towards the future of VC. If you had to, I mean, just with your experience that you've had, what you've seen from past trends and patterns in the past, looking ahead 5 years, what do you think the venture capital space looks like in terms of who's investing in it, what types of funds? Is it going to be more capital that is in markets like robotics, AI, climate tech, and these things that are going to really push society forward technologically?
Yeah, I'm not a good fortune teller. Uh, I don't have tarot cards or a crystal ball. Um, I would say that VC, like anything, goes in cycles. There are flavors of the month. Um, Definitely we're in a period of AI and humanoids being a flavor of the month. I think as investors, as investors, we have to do our due diligence, and really have to separate the hyperbole uh, from the facts. And if the fundamentals, make sense for the valuation, then and you say, well, this is gonna 10x, then it seems like a sound investment. I would say that you know, a good friend of mine, um, is and not all VCs are the same, Nick. I think we've been speaking like as if it's like a homogeneous asset class. There so there are financial investors, right? And each one has a different thesis, different organization. Some might be an extension of a family office. Like for example, the Wilf family I know very well. They own the Vikings. They have a separate VC, um, for their investments. There might be, they might be organized differently. Um, like for example, I've been on a investment committee process where it's very collaborative. We don't, we share in the investment pool that we invest in. While a place like Bessemer has partners, and each of them are given a certain amount of capital to invest out of, and they almost compete with each other. And so it's a very different organization, and you gotta really look in that. And I'm not saying which works better. Bessemer's a great fund. So not everything is the same. It's not apples to apples, and you really gotta, look at that. There are corporate investors, you know, if GM's making an investment, it doesn't matter how, successful that company is at an IPO, making billions of dollars. It's a pimple on the balance sheet of GM. And so it really has to make strategic sense for GM. So when GM invested in cruise automation, it really had to make strategic sense for them. I don't know if it's fully has, and they've had some hiccups on that, but you really have to. They tend to be different types of investors. They're not really that interested in the financial return, but in the strategic return. And one of the areas we get involved in with startups is building a cap table uh, that can help a company, go from successive financing rounds, help them through their growth trajectory. The cap table lists all the investors and the allocation and everything like that. So you want investors on that cap table that can not just invest in the current round, but can invest 2 rounds later, who can lead those rounds. You want corporate partners who can help them on the sales side, help them, with channel partnerships. Civ Robotics has Trimble and Bobcat as investors. Cambrian Robotics has Yamaha Motor and Festo Robotics. So you really want to help them on the sales side, help them on the supply chain side. So you really got to evaluate that. There might be government investors. Government could be a great partner. And so out there, and they can help move the ball forward when private capital doesn't. The Department of War budget is larger than most countries' budgets in the world. So it's not a homogeneous thing. And so you really have to understand all these different components, to really understand where you can involve yourself in, and where are the opportunities for yourself, for the startups you're affiliating with, and for your long-term goals.
That's amazing. And really appreciate all the insights that you've been able to share with us today. Kind of in closing here, I want to be able to for listeners, give them the resources they need. Who, if they want to learn more about what you're building at FF Venture, if they're looking to explore private investing more seriously, well, where should they go? Where can they find information? Obviously, go check out Oliver's book, A Startup Field Guide in the Ages of Robots and AI. I'm looking at it's on Amazon right now. You can pick one up here today. Yeah, tell the people what they need to
Go
know
to
if they wanna.
My name's Oliver Mitchell. I think there was a World War II boat called Oliver Mitchell, but if you go on LinkedIn, you could find me pretty easily, and connect with me on LinkedIn. That's probably the first place to connect, and we could take it from there. I'm happy to speak with you, schedule some time, and we could take it from there. And if you get the book on Amazon, I have chapters in the book about venture capital, really from the startup perspective and how to raise capital, and a lot of great stories of companies out there. And when looking at the future technologies, I'm very bullish on automation. I'm very bullish on AI, and it really has to make the most sense. So it can't just be a company that says Oliver.ai. Now you're an AI company. It really has to be something that's really revolutionary and changing how businesses are done and how you're generating more revenues. It's not just about, you know, displacing labor, and it really shouldn't be about displacing labor. It should be like, if I adopt this new technology, I can get 10 times more sales than I did yesterday.
That's amazing. Oliver Mitchell, everybody, find him on LinkedIn. You can check out FF Ventures website. Check out his book, as we've mentioned, A Startup Field Guide in the Age of Robotics and AI. Any final words of wisdom for our listeners? Favorite quote, favorite anecdote to share with us before we close off today?
Sure.
Sorry to put you on the
Uh,
spot like that.
no, sure. I would say, is to be humble. I think, um, it's really important to be humble. Um, I'm called the Robot Rabbi. My blog is called robotrabbi.com. And in my book, I talk, one of the things, to give sort of rabbinic, not quote, but a little idea out there, a little kernel of idea. Moses, who led the Jewish people out of Egypt, who brought the Ten Commandments to the world and brought the idea of monotheism to the world, was in many ways a great entrepreneur, and really, took a nation of slaves and brought it into building a tabernacle, a temple in the desert. And so, with the help of God. And so, but the rabbis say that Moses was the most humble person to ever live. So, how can you be a leader and at the same time be humble? And that's really, that duality of leadership and humility. And to take that sort of, rabbinic idea and combine it with a author I quote a lot, Dr. Seuss, uh, is that in the places you'll go, he says, bang ups and hang ups can happen to you, almost 99% guaranteed. So, don't get discouraged out there. The majority of startups fail out there, but it's perseverance is building a strong portfolio of lots of deals out there. And when you do get that big winner, remember to be humble.
Oliver, I can't think of a better message to end on. Thank you again so much for your time today, for your expertise and your knowledge sharing with us. Again, check out Oliver Mitchell, of all the places we've talked about, his book that we've talked about. And thank you so much for tuning into our show today. And we will see you next time. Thanks, everybody. Go check out his
Thank
book.
you. Thanks so much, Nick.
Absolutely. Take care.